The turmoil in the global financial markets is ebbing away. Today, the benchmark stock indexes are trading quietly. Investors are mulling over risks and revising their sentiment. Fresh macroeconomic data released today complemented the fundamental picture, but the market gave a muted response on the statistics. No wonder investors nervous are still jangling, and the quiet market could end up in a roller coaster. Following a slump in the early North American session yesterday, Wall Street indexes recouped losses in the late trade. The Nasdaq was the only index to close with gains. The Dow Jones came under the strongest pressure. It tumbled by almost 280 points and closed 0.87% down. The Nasdaq inched up by 5 points, 0.5%. The S&P 500 locked in intraday loss of 0.7% to close at 3,891 points. The benchmark indexes opened cautiously on Thursday. Futures on the stock indexes traded mixed. A weekly update on the U.S. unemployment claims pushed the indexes down. The S&P 500 is expected to trade in the intraday corridor between 3,820 and 3,940 points. Credit Suisse is to blame for pessimism on Wall Street yesterday, and the bank's shares crashed in the early New York trade due to fears about its future. Later on, the indexes regained their footing as the Swiss government was engaged in the talks of the options of stabilizing the giant bank. Still, the jitters with the Credit Suisse escalated pressure on the banking sector after the U.S. authorities took emergency measures for investors to stem the crisis after the collapse of SVB and Signature Bank. Some investors reckon that the Fed's aggressive monetary tightening entailed cracks in the financial system, and the Federal Reserve conducted their cycle of dramatic rate hikes unseen since 1980. Analysts suppose that the time has arrived to slow down. The Commerce Department reported yesterday that U.S. retail sales dropped by 0.4% in February, at the same degree as the producer prices. This encourages investors who cling to hopes that the U.S. Fed could ease the pace of rate hikes. Yields of U.S. Treasuries went down, and now traders expect a 50-50 chance of a rate hike by 25 basis points at the March meeting, or a pause in the cycle of monetary tightening. First Republic Bank shares plummeted by 21.37%. Westbank Corp shares fell by 12%. Western Alliance and the Charles Schwab broker changed the trend as their shares rose by 8% and 5% respectively. Top American banks, including JP Morgan, Citigroup, and the Bank of America, slumped. Thus pushed the banking sector in the S&P 500 down by 3.62%. Most of the 11 sectors in the S&P incurred losses. The energy sector logged the weakest results with a decline by 5.42%. Futures on the Wall Street indexes traded mixed in the pre-market. The Swiss National Bank threw live beyond onto the line Credit Suisse. Credit Suisse shares listed on the U.S. exchanges climbed by 8.8% in the pre-market after the bank was provided a bailout worth $54 billion by the Swiss National Bank to sustain liquidity and investors' trust. Still, the market gave a lukewarm response. The banking sector is still affected by jitters. Policymakers and the monetary authorities in Europe and Asia assured the public and the markets that banks in their jurisdictions are safe and well supported. The market seemed to believe. Last week, yields of 2-year U.S. Treasuries gyrated. On Thursday, yields hovered at around 4%, more than half of a percentage point lower than last week. Nevertheless, extreme volatility of safe haven assets arouses worries. Today, the U.S. authorities tried to calm down the panic. Treasury Secretary Janet Yellen affirmed that the U.S. banking system is healthy. Americans may be sure that their deposits could be withdrawn if necessary, she claimed. She also stated that the US government adopted measures to reinforce investors' trust and protect their savings despite the crash of a Silicon Valley bank. Apart from banks, Adobe shares rose by 5.8% in the pre-market, thus propping up the Nasdaq. The software developer upgraded its profit target for 2023. Meta and the Snapchat operator grew by 1.9 and 6.6% respectively after Joe Biden's administration warned to ban TikTok. The macroeconomic data released today was mixed. Building permits in the United States jumped by 13.8% to 1.524 million in February. The reading is the highest in the last 5 months and much higher than the consensus of 1.34 million. The manufacturing sector is losing momentum. The Philadelphia Fed Manufacturing Index went deeper in the negative territory for 7 months in a row. The index grew by a modest 1 point to minus 23.2. The market had projected a notable increase to minus 15.6. The labor market is a major headache for the stock market. The number of first-time unemployment claims declined by 20,000. 292,000 last week, much lower than the expected 205,000. The figure is fresh evidence of the tense labor market, thus dispelling optimism from a rise in the unemployment rate in February. The fundamental background arouses pessimism about stocks. The ECB's rate hike is another culprit of the sore mood. The overall picture is not complete for the United States, but the US Fed might revise its agenda at the nearest policy meeting. The currency market is seeking stability after highly volatile sessions. Trading instruments are trading at a low gear following a rally yesterday. The US dollar index slipped by 0.2% to trade at 104.40. The intraday corridor for the index is seen between 103.80 and 105.20. The euro and the Swiss franc have regained some of the losses in light of the news on the bailout provided by the Swiss National Bank to Credit Suisse. Major currencies are recovering and retracing from earlier highs and lows. This could be a lull before the storm. Forex might be hit by volatility again after the market digested the ECB policy decision. Like other central banks, the ECB pursued aggressive tightening. At the previous meeting, the regulator almost pledged to raise interest rates by 50 basis points. However, the latest market jitters raised doubts about this scenario. In practice, the ECB increased its repo rate by 50 basis points to 3.5%. The press conference is still ahead. Analysts will come up with their comments, so the picture is still incomplete. The market response could be unpredictable. On the other hand, a rate hike by 50 basis points may prove the bank's confidence in the financial stability. On the flip side, it might be another nail in the coffin and agile traders. The Canadian dollar traded on a seesaw like other major currencies. The USD card pair shed 0.13% intraday and is now trading at 1.3760. And oil prices rebounded a bit today, but went sharply down after the ECB's interest rate announcement. Traders are fretted by the prospects that central banks could derail economic growth. Brent crude futures fell by 1.5% to trade at $72.50 a barrel. WTI futures sank by 1.6% to trade at $66.60. The benchmark rates could incur heavy losses for 4 days straight. Yesterday, WTI tumbled below $70 for the first time since December 2021. Brent has lost nearly 11% since Friday and WTI has slumped by 12%. The International Energy Agency posted a report on the expected growth in the energy demand as a result of a recovery in the air fights and reopening of China's economy. The agency also noted that oil inventories in developing countries reached the highest levels in 18 months. Extraction of Russian oil remains at elevated levels despite Western sanctions. The crypto market is consolidating at highs, enjoying stability. Bitcoin settled at $24,800 intraday. Ethereum dipped below the psychological level of 1,700. Popular altcoins are trading mainly higher. Investors' behavior revived the idea that cryptocurrencies are viable assets at the time of a market turmoil. While commodity assets, stocks, and currencies are trading on a roller coaster, Bitcoin is heading for a multi-month high. Technical indicators confirm this idea, signaling a further rally of Bitcoin. According to TradingView, Bitcoin's dominance in the overall market capitalization reached the highest level in 9 months yesterday, surpassing 45.5%. The medium-term borders for Bitcoin are determined between $20,000 and $26,000. As for intraday forecast, the flagship crypto is expected to retest $26,000 if it climbs above $25,500. Good luck in your trading and see you tomorrow!